Well, I want to bring to you guys my investment plans for the next crash. As you guys know, in the past year, well, we had a pretty big dip in the markets, and that is not uncommon in the public markets whatsoever. And these publicly traded markets dip from time to time, and the recent ones being the 1999 dot-com bubble, the 2008 financial crisis, and I guess 2020 you could group that in as well. So that got me thinking. What if I could reverse back the clocks before 2020 actually hit? It is kind of unfair because I am looking in hindsight, and that is 2020. But what would we do? Well, we'd load up on a ton of tech stocks because they've been booming over the last year, such as Apple, Amazon, Facebook, Netflix. Any of those tech stocks have really been carrying the entire markets. Maybe I'd throw a ton of money back into Ethereum, Bitcoin, and Doge, especially all the way back last January. I would have had crazy returns. And of course, short some of the entertainment, travel, and restaurant industries because they were hit pretty hard. But we might not actually need a time machine to actually go back and figure this all out, because that doesn't really exist. And if it did, people would have shown up to Stephen Hawking's party because he actually sent out invites a day after he actually held it. Therefore, only time travelers would have actually attended. But no one attended, so we're going on that basis that there are no time travel. Anyways, I'm getting off topic. But over in the news, it has been spreading how there's new, different variations of the illness that took over 2020. I don't want to mention it because I don't want to be demonetized, but I think you guys know what I'm talking about. These other variants are spreading across the globe and are scaring a ton of people, and we are going to probably see this priced into the market. California just reinstated some mask mandates, and that is pretty much why we saw a big sell-off just a couple of days ago. This video is made on if I could go back and travel and redo everything that I did, but since I can't, how can I affect this for the future to be in the best possible position to profit big? And as always, like, comment, subscribe for the YouTube algorithms, and let's jump into it. So where else to start except for data? And the CDC actually updates the active cases in the US, and I'm gonna take a look at that. As you can see, over the time, it spiked up really quick, and once everything kind of settled down, it dropped dramatically. But now we're starting to see a quick incline recently. And they've named these different variants in Greek ways. First, they named the first one after me. Alpha. I'm just kidding, but they have actually named them after like Greek alphabet and stuff, so that we do have alpha, beta, gamma, and the list kind of goes on from there. But they say that the Delta variant is supposedly the most contagious, and just our luck, it's most prominent in the US and India. Supposedly 68% of adults are now vaccinated. However, those vaccinated are still actually getting infected by this new variant, so it's really starting to scare a lot of people. But I don't want to talk about any of these hot takes on politics. This is not a political channel whatsoever. This channel is specifically on personal finance and how you guys can make the most amount of bread out there. So let's start. What would I do if there was a round two? First things first, I would buy every single roll of toilet paper I could get my hands on. I'm just kidding, but what are some actual indicators that showed last time and might show this time? Well, very fast individual moving days. Well, we had a couple back to back to back, it seemed like. March 9th, 2020, the market dropped 7.9%. Then March 12th, another 9.9% negative drop. And then on March 12th, we dropped another 12.9%, which is massive when you're talking about the overall public market. You can look at market index ETFs as these indicators of the overall market, something like VOO, which tracks the S&P, or QQQ that tracks the NASDAQ. What we learned from this is that if you didn't panic, you just bought in consistently and bought the dip, you turned out pretty well after this year. And that was basically across the board on almost all stocks, but specifically the market in general. However, it was a little lopsided, as I mentioned earlier. The tech stocks really pulled their own weight. The tech companies actually had a massive pull, and they actually weighed 27% of the S&P 500. And without them in that, the overall market would still be down. So looking forward, these companies that don't actually have to be in person are mostly software companies and have very direct store to consumers. They're going to do very well. Amazon boomed, Facebook boomed, and Shopify boomed, and I would expect that to happen in the future as well. And also companies that focus on the hardware and software like Apple also boomed because people noticed that they needed their computers at home. But the odds of you actually timing it perfectly on the nose of their bottoms is pretty low, and to be completely honest, time the market is complete bull. the odds are is that you'll probably just miss it, and I'm sorry to burst your bubble, but you're not that special. If you miss the top 10 trading days in a 20-year period, you can cut your returns down by like 50%. So just buy it consistently, hold for long term, and you will outpace a lot of people. And just to reiterate, the stocks that would crash pretty hard would be the entertainment sector, the travel sector, and the restaurants. And for all my dividend investors out there, I'm sorry to say it, but your dividends are probably gonna get slapped pretty hard. If you keep up to date on multiple dividend stocks and you just see that a lot of them are starting to cut back their dividends, it's probably because there's some rough waters ahead. Moving on to the next very valuable lesson that we learned, don't screw around with Daddy Powell, because his printer will just outpace anything that you have coming in store. And let's be honest, it's much harder to predict the market than to just follow what the Fed is doing. And the more the Fed gets involved, the more the market will actually move. Just look at inflation hedging assets such as gold and Bitcoin. I believe gold's up like 23% year over year and Bitcoin up 315%. I can see these assets booming again, especially Bitcoin and cryptos in general, because people have a better understanding and are understanding the value within blockchain technology. What about other asset classes like real estate, one of the biggest? Unemployment rose and interest rates hit zero. Social programs like stimulus and home forbearance starting rolling out, and that helped a ton of people, but people were just cooped up in their homes. And when people were cooped up, well, they just started to save more because they didn't really have anything to spend it on. And mixed with the historically low interest rates, it created a perfect buyer's market. And the market was already on thin ice with limited amount of supply. And then with supply chain shortages, there's no other actual homes getting put on the market, therefore skyrocketing the entire market, and that's where we are today. Now in hindsight, you'd look back and buy a ton of lumber and then resell it, or even buy a ton of homes if you could. Now everything in this video has been talking about the past, but the odds of the future being the exact same way as the past are very, very slim. And the reality is it's probably not going to happen the exact same way. And the reason why is because specifically two main reasons. One of those being debt. A ton of companies borrowed a ton of money throughout the last year just to stay afloat, and this is bad debt. Okay, yes, this is a new day because this idiot did decide to talk to a dead camera for the rest of the hour. Anyways, let's carry on. Companies like Carnival Cruise just wouldn't be able to stay afloat because they had no cash flow coming in, and if this happens again, they probably won't be able to get the same bailouts and available cash that they had before. And in a normal environment, this is typically a 1-to-2 ratio. However, now it's a 1-to-3. Which again is still not astronomical, but when it is above 2, you probably should watch out. And carrying on, we gotta go to Congress. And since in the past, the politics of the United States were pretty well split. We had a Republican president with a Republican Senate, and we also had a Democratic House of Representatives, so it was really hard to get anything passed because no one really agreed on anything. However, now things have changed and everything is democratic, so things ideally should move a lot faster and just be more streamlined. And this is great for everyone in the market because this will actually help pump up the market and keep things rolling. However, this will polarize wealth a lot more because the rich will just get richer and the poor will just get poorer. They'll be left behind from all these market gains and then thus separate them even further. Well, you have to understand debt can be your friend in inflationary times. As inflation increases, debt becomes cheaper and cheaper. So therefore, the large corporations that have millions upon billions of dollars in debt will actually have that a lot cheaper than anticipated. And honestly, with everything upcoming, I would like to get into real estate. However, that market's pretty overpriced at the moment. However, if you can get in at a good price, it might be worth it. Because if you use a mortgage, the interest rates are 1, very low right now, and 2, the inflation ideally should eat that away. And then 3, you can actually get massive tax deductions, and 4, you have a physical underlying asset. So, well, what am I doing? Well, if stocks drop below like 4% in a day, I'm going to start plowing money into any ETF that I can. That is a pretty significant move in the overall publicly traded markets, so might as well get in as it is downtrending. And if Bitcoin falls below 25,000, I will consistently buy in. However, now it has rallied up quite heavily, and I don't know if it'll actually go back down there, and if it does, well, I'm gonna dump some money in there. But my biggest thing is don't try to time the market because the market just have ebbs and flows. It'll go down, it'll go up, but over time, if you just consistently buy in, you should have a good rate of return. And the odds are you're not going to time it perfectly, neither am I. I'm actually really terrible at timing the market, so I might as well just buy in consistently and just save myself the troubles and the headache. That's it for today. Thank you guys for watching, and I'll catch you guys in the next one.